Hi, I'm James Robinson, and this is my stock pick of the week. This is my fourth installment on the company Paychex. Today we're going to talk about dividends. So the first thing that we look at with dividends, obviously, is just what's the historical record with these dividends. We go back to 20 years ago. You can see that the company has raised its dividends. The chart on the left is the actual dollars paid out in dividends, not the dividends per share, but the total dollars they pay out to all shareholders. So you can see the company paid just about $100 million in dividends in 2000. Today they're paying almost $1 billion, $800 million. So that number's gone up every year, except for during the financial crisis. But it's worthy to note that during the financial crisis, the dividend didn't decrease; it stayed flat. That's important because, again, we're buying this stock in part because it's a decent dividend player at today's prices during the corona crisis. So I think that this stock might actually be able to maintain or keep its dividends relatively flat and not have them drop very much. That would be fantastic. And then the company, as the economy recovers, will recover, I think, as well or faster than the economy. So in terms of total dollars paid, this company has done a great job paying dividends, increasing their dividends. And the dividends are increasing at a higher rate every year. We're going to see more about that later. When you look at dividends per share, same kind of story. This company has bought back some shares, but not enough to really change this chart very much. The one thing that's of note is this weird bump or dip in 2012, 2013. I think that's a problem with the data that I've got. I can't find a record of that. It looks like the money that was paid out was consistent in 2013, but yet there's this weird dip in my chart. I could go back and figure it out, but frankly, it's 7 years ago and it's not that important to me. So I would just look at that little dip there in 2013 and think there might be something goofy going on. But that's the data that I have, and so that's the data that I'm using. So as always, when I'm looking at dividends, I look at them through four factors. First, I look at what's the yield, what's the return on investment for the shareholder. I look at the growth, how much is that yield going up year after year. And again, if you're a retiree and you're a dividend investor, you want to know what kind of return you're getting on your money, and you want to be confident that that's going to continue to grow over time and that it's going to grow at a rate which will outpace inflation in order that you can, you're never losing ground in terms of your wealth and your ability to sustain your lifestyle. We look at dividend safety in the context of its earnings. So is the company paying out an appropriate dividend relative to the amount of money that it makes? We look at dividend safety in the context of cash flow. Again, earnings don't always tell the whole story. So I also look at this from the standpoint of cash flow. And finally, dividend safety in the context of the current debt load. And that's really a look at, does the company have enough debt that if interest rates were to increase, they might become unable to pay those dividends due to the higher interest costs. So we'll go through all of those over the next few slides. So this slide, we're looking at the yield and growth for Paychex. The yield is 3.78%. That's based on the current share price, or the share price, I guess, on Monday when I bought the stock. The S&P 500 average is about 1.73%. Again, that was based on historical charts, but effectively this company, we're buying it today at better than two times the average dividend rate for the S&P 500. It's spectacular to be able to get a company that's this much above the pack in terms of its credentials, and to be able to do it and get a yield that's twice the yield for the S&P 500. That's fantastic. The dividend growth has averaged 10.9% for the last 5 years, so 3 times the rate of inflation. The idea here is if you buy this thing and you're going to live on the dividends, every year you're going to get a raise, even after adjusted for inflation, so that's pretty strong. You can see that the blue line is the dividends paid per share. In 2014, it was about $1.50 a share. Today, it's about $2.30 a share, so that's a nice increase over 5 years. The red lines are the percentage of increase, so it's gone up about, you can see every year, the worst year went up just under 9%, and it's gone up, 10 or 12% some years, and it's averaged out to 10.9% over the last 5 years. So yield is exceptionally good, historically speaking, and the growth rate is also exceptionally good. So here we're looking at dividend safety in the context of earnings, and what we're trying to analyze here is the ability of the company to continue to pay the dividend that they're paying. If, to use an extreme example, a company was paying dividends that were 150% of their earnings, that would be an unsustainable dividend. That would be a red flag. On the flip side of that, if the company's paying out 10% of their earnings in dividends, that would mean they're not really making much of an effort to return money to the shareholders. So we just want to get a sense of where this company is on that continuum between paying too much more dividend than is reasonable and not paying much dividend at all. So the current pay ratio for this company is about 79.8%. That's pretty high. The average payout ratio for the last 5 years is 78.6%. So in that same very narrow band. The average, put that in perspective, the average payout ratio for the S&P 500 is 40%. So what that means is of the dollars that they earn in profit, what are they giving us, the shareholders, in terms of dividend? And so for the S&P 500, it's 40%. This company is closer to 80%. That to me is verging on too high. The dividend becomes less and less sustainable when they pay a higher and higher percentage of their earnings, because if the earnings drop, then they don't have much of a buffer there to pay their dividends. But having said that, remember, we can reflect back to what happened during the financial crisis, and for 3 or 4 years the dividend remained flat. That was a strong sign this company is committed to maintaining their dividend. So that if you look at the chart, there's a lot going on here. The green line is the earnings that the company made. The red line represents the amount paid out in dividend. The gap in between is sort of the margin of safety. And the blue line is the payout ratio. And you can see that really doesn't, it looks like there's a big dip there in 2017, but there really wasn't. It was just, it went from 82% to 75%. So the dip isn't as big as it looks, because you have to recognize the scale of the chart. But so this is the one thing about this company's dividend that makes me a little nervous, that it is such a high payout ratio relative to their earnings. However, so we talked about dividend safety in the context of earnings. Now let's talk about dividend safety in the context of cash flow. So to break this down for you, this company had cash flow from operating activities in 2019 of $1.2 billion, $1.3 billion. The company has very little capital expenditures. That's one thing that I really like about this company. So their capital expenditures were $123 million. That gave us free cash flow of $1.147 billion. We paid $826 million in dividend. That was 72%. So the reason this company is able to pay such a high percentage of their earnings in dividends is because they have relatively low capital expenditures. Their business doesn't require a lot of cash to run year in and year out. And the benefit of that is that they're able to pay a higher dividend than most companies, because they don't need to keep so much money for their operations. So I'm actually much more comfortable looking at the company's dividend after I've looked at the dividends as it relates to cash flow than I was looking at the dividends related to earnings. So I hope that makes sense. So dividend safety in the context of debt. One of the things that we have to recognize here is that companies with a lot of debt have exposure that the interest rates might go up. And when they do, even though their debt might not change, their carry costs over time are going to increase, and sometimes dramatically. So what I look at is, I look at the company's ability to pay their interest and the dividends not being altered. So, and I do that at various interest rates. So I start at 4%, 5%, work my way up to 20%. So let's just use 20%, which is astronomically high. I don't know that America's ever had interest rates much above 18 or 19%, but let's just say it was 20%. So if the interest rate was 20%, the company would have to pay $127 million in interest. So the new interest adjusted cash flow would be $1 billion. So after paying that interest, they'd have cash flow of about $1 billion. They currently pay dividends of $826 million. So free cash flow minus dividends is $193 million. So that means that the dividends, if the company's paying 20% interest, would still only be using up 81% of the cash flow. That's basically, the company may as well have no debt. And that's one of the things that I like about this company, is that they have so little debt that I don't have to worry about the debt impacting their ability to pay their dividends to us as shareholders, or to bankrupt the company, for example. So in summary, this company is a solid payer of dividends. Even through the recession of 2008, they didn't drop their dividend. The dividends have gone up pretty much every year except the recession of, the Great Recession of 2008. So the dividends themselves are pretty good in terms of yield. The company pays a 3.78% yield, roughly based on today's prices. So that's exceptional. The dividends have grown at 10% a year, so 3 times the rate of inflation. That's exceptional. The company's payout ratio is a little bit high relative to earnings. It's a little cause for concern. However, when you look at the payout ratio in the context of cash flow, it's better and less concerning. The company has so little debt that I don't think that debt is going to be, even extraordinarily high interest rates are going to cause this company to have to reduce their dividends. So it's a very safe dividend play if you want to do that. And I almost look at it like a fantastic way to bank some money. What I mean by that is I don't know what's going to happen. I think the economy is going to recover from the coronavirus thing, but I don't know how long that's going to take. But I think that Paychex is the kind of company that's going to reward me to own it by paying me some dividends, and then in the long term reward me to own it by having the earnings ramp back up, the stock price will recover, and we'll do real well in the long term. I don't know that this is a 3-month or 6-month turnaround. It might be an 18-month turnaround, but I think it could double or triple in that period of time. So it's a long-term play, as all of my investments are right now. But I think it's something, you can look at this dividend and be pretty comfortable.